Hi, I'm Rick Kaler. Thanks for joining me. Britain shocked the world last week when its citizens decided, on a vote of 52 to 48%, to leave the European Union. The uncertainty of how this complex divorce will play out over the coming decade sent global markets reeling. London's Financial Times Stock Exchange 100 lost 4.4% of its value in just one day. The British pound sterling, well, it was down 14% against the yen and 10% against the dollar, again in one day. The financial news media, it went berserk. Britain has 2 years after notifying the EU of its intention to leave to negotiate its exit with policymakers. So we can expect the markets to remain volatile for some time. But why all the fuss? Well, the thinking is that British companies will lose access to the European market for duty-free trade in financial services. Some think that with Britain no longer part of the European Union, London will be unable to function as Europe's financial center. It's done this since companies have long seen Britain as the gateway to free trade with the 28 nations in the EU. Eventually, Britain could lose American investments and manufacturing jobs, which could move across the channel to mainland Europe. However, this is all speculation. Nobody knows exactly how the Brexit will play out long term. One reason it's unwise to assume the worst is because the Brexit vote is not legally binding on the government. Since British Prime Minister David Cameron resigned his post and called for a new election by October, it's possible that the new government might delay their decision to withdraw from the EU, or Parliament could instruct the new Prime Minister not to notify the EU that Britain is withdrawing until the government has had a chance to further study the implications. There could even be a second referendum to undo the first. Given all of these uncertainties, what was and continues to be my advice to investors? It's quite simple. Do nothing. Current market disruptions represent an emotional roller coaster, a short-term panic reaction to what is likely to be a very long-term, well-constructed exit from the EU. British companies were certainly not 4% less valuable the day after the vote than the day before. And the pound sterling is not suddenly a second-rate currency. The US, China, and Japan are not part of the EU. Global economies function fine, and they will continue to function without Britain in the EU, just as they functioned well before the EU was created in 1989. The emotions of traders and speculators are driving the short-term market responses to a long-term event that will be worked out by reasonable people who will have their nation's economies and their nation's best interests at heart. Long-term investors who sold because of the Brexit will undoubtedly realize they were suckered and manipulated once again by panic masquerading as an assessment of real damage to the companies that they've invested in. The good news is that long-term investors who are diversified have only a minority of their portfolios in equities. While the Brexit was not good in the short run for Britain's currency and global equity markets, it was a positive for investment vehicles like gold, bonds, and managed futures, which all profited nicely upon the news of the Brexit. The strategy of global diversification worked again. And if equity markets decline sufficiently, long-term investors will be able to rebalance their portfolios by selling a portion of what has appreciated and buying equities. This is called selling high and buying low. However much short-term disruption there may be, Britain and the EU will find a way to move through this unexpected event without too much damage. as every other recent short-term financial calamity has, Brexit will become just another blip on the long-term charts. Thanks for joining me.